Hello there, everyone. It is great to have you back with us. Sometimes reality is truly stranger than fiction. If you had told me just a week ago that the global silver market, a market worth hundreds of billions of dollars, would be brought to its absolute knees because the President of the United States wants to buy a frozen island in the North Atlantic, I would have told you to check your medication. But here we are. The Greenland tariff has just changed the world, and specifically, 10% tariffs have effectively cut off the LBMA. While the mainstream media is laughing about real estate deals, the financial plumbing of the precious metals world is jamming up in a way we have never seen before. It is Sunday, January 18th, 2026, and the landscape has shifted beneath our feet. By now, you have probably seen the headlines. The mainstream media is having a field day. They are laughing. They are making jokes about the president trying to buy Greenland again. They are interviewing Danish politicians who are outraged. It is an absolute circus out there. I want to know what you think right out of the gate. Is this political theater, or is it 4D chess disguised as a real estate deal? Let me know in the comments below. But while the media is laughing, the bullion banks in London and New York are screaming, because buried in that tweet, hidden behind the headline about purchasing Greenland, is a single sentence that effectively destroys the logistical pipeline of the global silver market. The president has announced a 10% tariff on all imports from 8 European nations, including the United Kingdom, starting on February 1st. And if a deal for Greenland is not reached, the tariff jumps to 25% on June 1st. To understand why this is such a catastrophe, we have to look past the politics and into the risk management offices of the major banks. To the average person, this sounds like a trade dispute. It sounds like politics as usual. But to the risk manager at a major bank like JP Morgan or HSBC, this is a nuclear bomb. Let me explain why. The global silver market relies on a concept called fungibility. It relies on the idea that a 1,000-ounce bar of silver in London is the exact same thing as a 1,000-ounce bar of silver in New York. And more importantly, it relies on the ability to move that bar back and forth cheaply and easily. The banks play a game. We call it whack-a-mole. When the price of silver rises in New York because of high demand, the banks take silver out of their vaults in London, specifically from the LBMA, and they fly it to New York to flood the market and push the price down. Conversely, when London runs dry, which is happening right now due to massive Indian and Chinese demand, they take silver out of the Comex vaults in New York and fly it to London to refill the shelves. This constant flow of metal across the Atlantic Ocean is the lifeline of the suppression scheme. It allows the banks to pretend that there is always enough silver because they can just shuffle it to wherever the fire is burning hottest. But here's the problem. That lifeline just got cut. What happens when you put a 10% tariff wall in the middle of the Atlantic Ocean? The United Kingdom is on the tariff list. The LBMA is located in London, which is in the United Kingdom. This means that starting February 1st, if a United States bank ships silver to London to bail out the LBMA and then tries to bring that silver back to the US later, they will have to pay a 10% tax on the value of the metal. At $90 an ounce, that is a $9 tax per ounce. That destroys the profit margin. It destroys the arbitrage. It makes the whack-a-mole game mathematically impossible to play. Essentially, the president just turned the United States border into a one-way valve for silver. Metal can come in, perhaps, if it comes from a non-tariff nation like Mexico, but metal cannot leave for London because if it leaves, it can never come back without a penalty that wipes out the bank's equity. This creates a trapped inventory scenario. The risk managers at the major banks are looking at this tweet right now on a Sunday, and they are issuing a stop-move order. They are telling their logistics teams to halt all exports. They cannot risk sending metal to London if they cannot get it back. This logistical freeze creates a massive disconnect between the world's 2 largest pricing hubs. It effectively cuts the LBMA off from the Comex. And this is happening at the worst possible moment for London. We know, based on the vault data we analyzed previously, that London is critically short of physical metal. The flows to India and China have drained the LBMA vaults to historic lows. They were counting on the 4.2 million ounces that were withdrawn from the Comex on Friday to save them. They were waiting for the cavalry to arrive from New York. But because of this tariff news, the cavalry is not coming. The silver that was supposed to fly to London is now grounded in New York. This transforms the situation entirely. We thought that metal was leaving the country, but now it is likely stuck here. This is bullish for the US price, but it is catastrophic for the London price. Does this make sense to you? Are you following the logic of how a tariff acts as a trap? Sound off below if you've ever seen a market structure break like this before. If London cannot get supply from the US, and they cannot get supply from the miners, where do they get the metal to settle their contracts? They do not. London goes into a physical default much faster than New York. The Greenland tariff is a black swan event. It is an event that nobody predicted, nobody priced in, and nobody has a model for. The algorithms that trade silver are programmed to look at interest rates, the dollar index, and industrial demand. They are not programmed to calculate the impact of a real estate dispute over an ice sheet in the Arctic. This brings us to the human element of the trade, which sees what the machines miss. The machine sees a trade war. We see a liquidity trap. The banks are now forced to make a choice. They have to choose which market to save. They can keep their metal in New York and let London burn, or they can send metal to London and trap it there forever, leaving New York exposed. Because these banks are mostly domiciled in the US or have massive US operations, they will likely choose to protect the Comex. They will circle the wagons around New York. This leaves the LBMA exposed to the full force of the Asian demand we have discussed. The Shanghai vacuum is still sucking metal out of the system. And now the New York spigot has been turned off. We are about to see a bifurcation of the Western silver market. We might see silver trading at $90 in New York and $110 in London simply because the metal cannot move between the two cities. The law of one price has been repealed by executive order. Now let's drill down into a specific mechanism that makes this situation absolute life and death for the bullion banks, the location swap. In a normal world, silver is liquid. It flows like water. If a major bank has too much silver in New York and not enough in London, they do not just physically ship it immediately. They often do a swap. They trade ownership of bars in New York for ownership of bars in London with another bank. The system relies on the assumption that eventually the metal can be moved to balance the books without a penalty. It relies on the idea that an ounce of silver is worth the same amount on both sides of the Atlantic, but the president's 10% tariff has just destroyed that assumption. He has turned the United States bullion market into a Roach Motel. You know the old slogan? Roaches check in, but they do not check out. Well, now silver checks into the US, but it does not check out. Here's the logic that every risk manager on Wall Street is grappling with this Sunday morning. Let us say you are a bullion bank. You see that London is desperate for silver. You want to ship 1 million ounces from your Comex vault in New York to your LBMA vault in London to stop a price spike. Sending it there is easy. There is no export tax. You put it on a plane, it lands at Heathrow, and you save the day in London. But what happens next month? What happens when the Comex runs dry and you need to bring that silver back to New York to settle a futures contract? Now you have a problem. Because that silver is coming from the United Kingdom, it is hit with a 10% tariff at US Customs. If silver is trading at $90, you have to pay the US government $9 for every ounce you bring back. That $9 comes directly out of your profit margin. In the low-margin world of bullion banking, a 10% hit is not a loss. It is a catastrophe. It wipes out the profit of the trade 10 times over. So the risk manager looks at the spreadsheet and says, we cannot send the silver to London because once it leaves US soil, it effectively costs us 110% to get it back. The silver is trapped. This destroys the whack-a-mole game we discussed. The banks can no longer smooth out the volatility. If London spikes to $120 and New York stays at $90, the banks cannot step in to close the gap because the tariff wall is in the way. This creates market segmentation. It means we are going to see wildly different prices for the same asset depending on where it is sitting. And that leads us to the accidental genius of this political move. The media is focused on Greenland. They think this is about ego. They think it is about real estate. But look at the effect of the policy, not the headline. By trapping the silver in the United States, the president has created a domestic strategic reserve. We talked previously about the need to secure critical minerals for national security. We talked about how the US Mint was running out of metal. Well, this tariff solves that problem instantly. If the banks cannot export silver to London because of the tax risk, that silver stays here. It stays in the Comex vaults. It stays available for Tesla. It stays available for Raytheon. It stays available for the US Mint. It forces the ghost supply to remain within the borders of the United States. It is America First applied to the periodic table. I'm curious, do you think this accidental reserve is actually the primary goal? Is the government finally realizing they need silver for weapon systems? Drop a yes or no in the chat. It forces the rest of the world, specifically Europe and the United Kingdom, to fend for themselves. It tells London, you are on your own. You cannot raid our vaults to save your exchange anymore. This puts the LBMA in a death spiral. London is the hub of the global physical trade where the vast majority of silver flows to India and China. If London loses access to the US stockpile, they have zero buffer left. We know their vaults are empty. We know the float is gone. And now we know the resupply line is cut. This explains why that specific withdrawal we saw on Friday is so critical. Remember the 4.2 million ounces that were withdrawn from the Comex on Friday? On Friday, we thought that metal was leaving the country. But with this tariff announcement coming on Sunday, that metal is likely stuck. It is sitting in a warehouse near JFK Airport wrapped in plastic with nowhere to go. The owner of that metal has a choice. They can ship it to London and eat the future tariff risk, or they can keep it in the US and sell it to a domestic buyer. Given the uncertainty, the smart move is to keep it here. This means that the physical squeeze in the United States might ease slightly in the very short term. But the physical squeeze in London is about to go nuclear. And because silver is a global asset, if London breaks, the whole system breaks. You cannot have silver trading at $200 in London and $90 in New York for long. The panic will spread. But there's another layer to this logistics trap that hits the refiners directly. Many of the major refiners that supply the US market are located in Europe and Canada. If the tariff applies to any and all goods from these nations, then imported silver bars just got 10% more expensive. This raises the replacement cost for US dealers. If the major dealers want to buy silver eagles and the US mint is closed, they often buy rounds from private mints. But those private mints buy grain from refiners. If the refiner is in Europe, the cost of that grain just went up by 10% overnight. That cost gets passed on to you. So even if the spot price stays at $90, the premium on physical silver in the US is about to jump again. The dealers have to price in the tariff. This validates the $120 street price we have discussed. The tariff acts as a floor for premiums. It bakes inflation into the physical product. We are watching the balkanization of the financial world. The globalized, frictionless trade of the last 30 years is over. We are entering a world of walls, tariffs, and trapped assets. In this world, having physical metal in your own possession is the only safety. You do not want to own a contract for silver in London if London cannot get delivery. You do not want to own an ETF that stores its metal in a jurisdiction targeted by a trade war. You want the metal in your hand. Now, let's shift our focus across the ocean to see what this looks like for the LBMA specifically. Monday morning in London could be the start of a historic default. New York is trapped, London is starving, and Shanghai is feasting. The logistics have broken and the price is next. We have analyzed the Roach Motel effect in New York, but to understand the full gravity of what happens when the markets open on Monday, we have to look at London. The London Bullion Market Association is the beating heart of the global physical trade. While the Comex in New York is a futures casino, London is where the big physical deals are settled. For the last 3 years, London has been bleeding. We have watched a relentless exodus of silver from the LBMA vaults toward India and China. The inventory in London has dropped to levels that many analysts consider critical. The amount of silver that is unencumbered, meaning it is not already owned by an ETF, is frighteningly low. London has been surviving on a lifeline. That lifeline was the ability to import metal from the Americas when things got tight. When the vaults in London ran dry, they could call up the bullion banks in New York to ship millions of ounces, and the banks would do it. They would execute a location swap to keep the game going. But yesterday, the president cut that lifeline by imposing a 10% tariff on imports from the United Kingdom. He made that transaction financially toxic. No bank in New York is going to ship silver to London if they have to pay a 10% penalty to bring it back. So London is now an island, literally and financially. They are cut off from the Comex. They are cut off from the Mexican supply chain. And they are still facing the insatiable demand from the East. This creates a siege mentality in the city of London. When the sun rises on Monday, the traders in London are going to wake up to a new reality. They are going to realize they are insolvent in physical terms. They have sold more silver than they have access to, and the backup supply from New York is not coming. This is the recipe for a local default. We could see a situation where the price of silver in London disconnects completely from the price in New York. We could see silver trading at $90 in the US, but $110 in London. Why? Because in London, the metal is scarcer, and because it cannot be arbitraged away due to the tariff, the price difference will stick. This kills the concept of a global spot price. If you have a price in Shanghai, a price in London, and a price in New York, which one is the real price? The answer is the one where you can actually get the metal. The bifurcation of the market is a nightmare for the banks because it destroys their hedging models. Most banks run a global book. They might be long silver in London and short silver in New York. In a normal world, these positions cancel each other out. They are hedged. But if the price in London screams higher than New York, their hedge breaks. They start losing money on the spread. This forces them to close their positions. They have to buy back their shorts in New York and sell their longs in London. This creates buying pressure in New York. The tariff that traps silver in the US actually forces the US price to rise. The banks have to buy New York contracts to cover the risk that London blows up. So the idea that trapped inventory would crash the US price is wrong. It creates a panic bid as banks scramble to rebalance their broken books. This brings us to the most dangerous part of the equation, the unallocated accounts. Millions of investors hold unallocated silver with LBMA member banks. This is essentially a fractional reserve banking system for metal. If London is cut off from supply, the risk of an unallocated default skyrockets. If you hold unallocated silver in London, you're basically holding a paper IOU from a bank that just lost its main supplier. When the market realizes that London is besieged, we expect a massive run on unallocated accounts. Investors will rush to convert their unallocated credits into allocated bars, but there are not enough bars. This forces the banks to go into the open market and bid for any metal they can find. This is how a liquidity crisis turns into a solvency crisis. The Greenland tariff has exposed the fragility of the global system. It showed us that the silver market is not a unified ocean. It is a series of connected pools. London is now draining fast. New York is filling up with trapped capital that cannot leave. This makes the US market the most secure market in the world. If you own physical silver in the United States, you are holding strategic inventory. But if you own paper in London, you are holding a liability that is about to be tested. The divergence between the two markets will likely create chaos. On Monday morning, we might see the arbitrage bots malfunctioning in wider spreads. This is what happens when the logistics break. The pricing mechanism fails. However, we need to pause and look at another group that is waking up in a cold sweat this morning, and it is not the bankers. It is the industrial titans. We often get so caught up in the financial games of the Comex and the LBMA that we forget what silver actually is. It is not just a monetary metal, it is a strategic industrial metal. For the last 2 decades, companies like Apple, Samsung, Tesla, and the major solar panel manufacturers have operated on a just-in-time delivery system. They do not hold massive stockpiles of silver. They rely on the global supply chain to deliver exactly what they need, exactly when they need it, at the lowest possible spot price. They have outsourced their inventory management to the market, assuming the metal will always be there. Well, that assumption just died on the vine. Imagine you are the purchasing manager for a major solar manufacturer or an electric vehicle battery plant in the United States. You need millions of ounces of silver paste to coat your photovoltaic cells or for your contacts. Your supply contract might be with a refiner in Germany or a distributor that sources from the LBMA. Suddenly, that supply is hit with a 10% tariff. Your cost basis just exploded. But it is worse than that. You're not just worried about the price, you are worried about availability. You look at the headlines, you see the stop-move orders, you see the trapped inventory, and you realize that the silver you need to keep your factory running next month might not arrive. What do? You do not wait for the price to settle. You do not wait for the dip. You panic buy. You pick up the phone and you buy every single physical ounce you can find within the United States borders, regardless of the premium. You front-run your competitors because you know that if you run out of silver, your assembly line stops. And if your assembly line stops, your stock price crashes. This is the industrial fear trade, and it is far more powerful than speculative demand. When an investor buys silver, they want a return on investment. When an industrialist buys silver, they want survival. They are price inelastic. They will pay $100, $150, whatever it takes to secure the metal. This industrial panic is going to collide head-on with the banking crisis we just described. You are going to have the bullion banks trying to cover their shorts at the same time that Tesla and Raytheon are trying to secure their strategic stockpiles. And they are all fighting over the same trapped pool of inventory inside the US. This is the catalyst for the super spike. The paper price, set by futures contracts, becomes irrelevant when Apple and Tesla are bidding directly for physical bars. I'm curious, do we have any industry insiders watching? If you work in electronics, solar, or manufacturing, are you seeing supply chain tightening yet? Tell us what is happening on the ground in the comments. Furthermore, we cannot ignore the geopolitical retaliation. Do we honestly believe that the United Kingdom and the European Union are going to take this lying down? They are not. We are about to witness a tit-for-tat trade war that will likely target U.S. exports. But more importantly, this move by the U.S. president signals the end of the dollar standard in commodities pricing. If the U.S. can weaponize the dollar and the border to manipulate the silver price, then other nations will seek alternatives immediately. We could see the BRICS nations accelerate their move to a resource-backed trading mechanism simply to bypass the risk of U.S. tariffs and sanctions. The Greenland tariff is essentially a declaration of economic warfare, not just on an island in the Arctic, but on the current structure of global trade. It accelerates the trend of deglobalization. It tells every nation on Earth, if you do not hold the physical asset within your own borders, you do not own it. This realization is going to trigger a wave of resource nationalism unlike anything we have seen since the 1970s. Countries like Mexico and Peru, the world's largest silver producers, are watching this. If the U.S. is hoarding silver, why shouldn't they? Why should they export their real wealth for devaluing paper currency? We might see export bans from producer nations, which would be the final nail in the coffin for the LBMA. The supply shock is coming from all sides. Import tariffs in the north, potential export bans in the south, and an insatiable industrial vacuum in the middle. The industrial user is no longer a passive buyer. They are now an aggressive hoarder. So where does that leave us? Let's bring this all to a conclusion. The world of silver we woke up to this Sunday morning is fundamentally different from the one we lived in on Friday. We have deconstructed the Roach Motel logistics and exposed the crisis facing the LBMA. The era of a unified global frictionless silver market is over. The President's executive order reintroduced the laws of physics and geography into a market that had forgotten them. So what does the future look like? We are not going to make a prediction for Monday morning's exact open price. The price could gap up $20, or the banks could try to smash it down one last time. Instead, we are going to look at the long-term structure. We are entering the era of regional pricing. In this new era, the price of silver will be determined by where it sits. Metal inside the United States will trade at a premium as strategic silver. Metal in London, however, is now stranded silver, disconnected from production in the Americas. This bifurcation destroys the ability of the commercial banks to suppress the price. Suppression requires certainty and the global flow to bail the banks out. But the tariff introduces basis risk, the banker's nightmare. If the tariff wall prevents moving metal, their hedge falls apart and they are exposed. When banks face unquantifiable risks, they stop shorting and reduce leverage. The paper shorts are leaving the building because the game has become too dangerous. Without artificial suppression, silver will finally be free to find its natural equilibrium. It is a price high enough to incentivize new mining in a world where energy is expensive. It is a price that reflects silver's status as the unsung hero of the digital economy. So what is the verdict for you, the individual investor? Strategy number 1, geographic diversification is dead. In a world of trade wars, moving metal across borders is becoming impossible. The safest place for your silver is where you are. Strategy number 2, ignore the spot price. The spot price you see on TV is now just a math error, an average of 2 broken markets. Value your stack based on replacement cost. If you sold your silver today, could you buy it back? What premium would you pay? And finally, strategy number 3, the long game. The tariff on the UK is just the first domino in a shift toward resource nationalism. Every country is going to start hoarding what they have. We are returning to a world where hard assets are the only collateral that matters. The tariff trap has locked the door. The silver is staying here. As we head into this week, expect chaos and confusing statements from the banks. But you know the truth. You know that the logistics have snapped. We just need to know that the trajectory is up and the floor is solid. The government has inadvertently rigged the game in favor of the physical holder. Before you go, I need to know your strategy. Are you holding, buying more, or waiting for a dip? Leave a comment with your move. Thank you for being part of this community. You are here because you want the research. You want the dots connected. The week ahead will be one for the history books. Stay safe and keep your eyes on the physical reality, not the paper illusion. We will see you on the other side of the open.